Okay, great. All right, Sarah and Steve and all of you, thank you for having me talk about 1031 exchanges. I have a PowerPoint up on the front here, and I'll be talking about, there's a lot of slides here, there's a lot of legalistic. I mean, you folks are selling real estate. I'm going to try to gear it to that, and to the extent I miss anything or skip anything, you can reach out to me at any time, okay? And Sarah, you're seeing my like-kind exchanges screen, correct? Excellent, excellent. All right. So first of all, I'm from First American Exchange Company. We are wholly owned by First American Title Insurance Companies. So you need to know that when you bring your clients here for an exchange, that their money is being handled by the same folks that handle the title insurance money. We handle billions of dollars. We have a banking team, and we keep your accounts in segregated accounts. So rest assured, you've got a strong public company watching your clients' money. Okay. This is me. It's an old picture. It looks good. Sarah sees what I look like, so whatever. This is me. I've been in this business. I've been a lawyer for 38 years. I've been in this business exclusively for 21 years. So I've seen a lot of things. I have not seen everything. All right. But chances are, if you ask a question, I've seen somebody's way of handling it. I can't give you or your client tax advice. I can tell you what I've seen. Okay, and I can help them find a solution. And I have a short list of good contacts, lawyers who know 1031. There are very few. Accountants who know 1031. There are very few who can help your clients when they need something special. But normally, most of the deals are vanilla and easy. Okay. Now, essentially, also, before I start the presentation and start talking, and I want to send you some things after this presentation. I know Sarah's going to send me some email addresses, and I want to send you out something that you can use when you're out there selling. And you don't need to remember everything we say here. You are not going to remember everything we say here. It's too hyper technical. But we do have a nice cheat sheet that I can send to you, and the basics, the things you need to know about 1031, the questions we get all the time. What are the deadlines? When, what kind of properties can be exchanged? What are the investment requirements? Things like that. What is a fully deferred exchange? Can I take some money out and have some boot? The same taxpayer requirement is a very important one on the buy and sell, and often misunderstood. And most important, the identification rules. So I'll send those to you, and I would recommend you keep them with you, maybe even put them in your brochures when you give them out, and people will know that you know the answers to these questions and someone who can get them to you. I also want to introduce you to something that's really unique in our company. I don't know of any other qualified intermediary that does it but First American, and it's called Invest Eagle. And I'll send you this brochure as well. Invest Eagle is a portal that we've set up to list properties. We've invited brokers to list your properties free of charge, and we've invited all of our clients and anyone else really to go in and search for properties. Very often our clients have said, I'm having trouble meeting the 45-day deadline. What is out there? What do you have? Do you know anybody that's got something for sale? And of course, we don't at the moment. And then other times brokers are saying, I have the perfect property for a 1031 buyer. And I really don't know a buyer that really needs one at the moment. They haven't told me, and I can't really reveal tax confidences anyway and give out names. So if you put your properties, and I don't know what Keller Williams requirements might be, maybe you can look into that, Steve or Sarah, but if you list your listing properties here, they look like Crexy, they look like all the other CoStar, they look as big and beautiful. You can post your properties, you can take them off, you can amend them. The client who sees your property would click a link and go directly to you. We are not a middle person. We don't charge anybody anything. We don't take anything. We're just trying to put people together and maybe have a little stickiness to our name. So look for this when I finish this and I send these out to you. And certainly ask any questions about it if you want to before we end. All right, let's get back to the, here we are. Back to the presentation. And so essentially, what is 1031? 1031 is very, very simple. It's simply, these words sum it up. You're deferring taxes on capital gains when you exchange like-kind property, it's got to be held for investment, used in connection with a taxpayer's business, or held for investment, either one. So your client might be operating a law office and want to sell that. That's fine. Or most of this is about rental. Oh, hello. Did you hear that, Sarah? Okay, very good. So it's really about deferring taxes. I mean, this is important. This has been in the tax code since the 1920s, okay? This is not new. It's used an awful lot, especially this year. And essentially, it's a deferral of tax. You're not getting rid of it completely, okay? It's important to know that they're kicking the can down the road. But if you kick the can down the road long enough and you pass away, very often you're going to get stepped up tax basis, okay? So that means that if you pass away, your date of death value controls, your heirs could sell the property tomorrow and pay no tax on the gains. The gains we're talking about are not just capital gains taxes, it's depreciation recapture. And I'm sure many of you understand that. Business properties have been depreciated. When you sell them, the first tax you pay is paying your gains up to the point at which you took depreciation. That's at 25%. We'll talk about that on another slide. That, in addition to the growth in gain, is what you're deferring tax on, okay? Who is a taxpayer? Any U.S. taxpayer, okay? Any U.S. taxpayer, even if they happen to be a foreign person, if they're a U.S. taxpayer, they can do a 1031 exchange. The benefit to your client, obviously, look, the benefit is additional cash to reinvest. They can consolidate or change portfolios by region or type. You may have a client that has been owning their rental properties in Massachusetts all these years, and they're moving to Florida, and they want their rental properties to be near them. So they want to sell the Massachusetts properties and buy Florida properties. Great. This is perfect for that. You don't pay capital gains, use all the cash to buy those new properties and change regions. It's very efficient recycling of capital. And people can respond more easily to a changing market. Some of your commercial clients might want to go from office to multifamily housing, or multifamily housing to warehouse. They may want to go into different types of assets in different locations. That's what 1031 allows. Very, very beneficial. All right, so capital gains. Taxable income from selling an asset for more than its tax basis. So what is the tax basis? Essentially, your client's tax basis is what they paid for property minus depreciation plus capital improvements. And so that's your tax basis. So in this example, you've got a sale price of $1 million. The tax basis is $100,000. The client probably bought the property for a few $100,000 and depreciated it down to 100. So here we are now with the tax basis. That is your client's money into the property. All right. But they're selling for $1 million. All right. The original price was 300. The depreciation was 200 here. So they're going to have $900,000 in gains to pay taxes on. All right. So what are they going to pay? Well, depreciation recapture, as I told you, is 25% tax. That's not your 15 and 20% capital gains tax. So that's a higher number than they're expecting. That would be, if we go back to that last slide, on this $900,000 in gain, the 25% would be on that depreciation amount, 200,000. So the first 200,000 of the gain is taxed at 25%. Then we get the federal capital gains tax, which is either 15 or 20%, depending on your client's income that year. Generally, it's if it's up over 400-ish, 400,000, it's going to hit the 20% range. And then you've got state tax too as well. So your state is going to tax you. Massachusetts, I think, I don't know if it's the 6% rate or the higher 12%, but states have various income tax rates for gains as well. Then if your client has a lot of investment income, if your client does a lot with hedge funds and stocks and other kinds of assets and has more than singles 200,000 in investment income, or married 250 in investment income, the gain on this real estate will incur a 3.8% tax. It's called a Medicare tax, a healthcare tax. So all of these taxes get deferred in a 1031. All right. So here your gain is 900,000. We do these estimated numbers for federal income tax, and we assume 6% on 900,000. These are the kinds of taxes you would save by doing a 1031. Okay. The prior tax basis of 100,000 moves to the new property. So if you buy for the $1 million that you sold for, your new property has a basis of 100,000. and it's
Hey,
worth $1
Bill,
million.
can I ask
Yes,
a quick question? Art is
sure.
asking, so are you still on the slide that has at the top depreciation recapture?
I have one of the slides, but I can go back to that one. This one?
I just wanted to make sure that we were on the right slide.
I'm on, it starts depreciation recapture, correct.
Perfect, thank you.
Okay, I generally speak off the slide, so if it looks, but ask anytime, okay? And I don't have the other box open, I don't see it, so you'll have to tell me when people ask questions. Okay, great. So at any rate, if you sell for $1 million and buy for $1 million, your basis stays 100,000 in the new property. Your gain is $1 million built into the new property. If it grows to $1.5 million, you now have more gain, and you could do another 1031 later. So that's what this is all about.
Could you just confirm, sorry, Bill, we can defer
Sure.
both federal and state tax?
Very good question. You can defer state tax in almost every state. Most states follow the federal law on 1031. Couple of caveats. Pennsylvania doesn't, except for corporations. And it's a quirk in the way their tax code works. It's not that they chose to give corporations benefit, it just works that way. So if you have a Pennsylvania client, they won't defer the state tax, but Massachusetts, for example, you do. Some states have a clawback when you sell the property at a gain someday. If you don't continue to do 1031s until you die, Massachusetts will want its share of the gain. They don't really have any way of enforcing that. I don't know how they figure it out. You're supposed to do it voluntarily and go back and pay the tax. California, if you have California clients, they have a mechanism in place where you will report what you did with that property every year forever. And when you sell on that property, you will have to pay California its share of the gain. So yes, they all just about defer. Some have clawbacks.
And really quickly, Deb Higgins wants to know, is it where you live or where the property is that defines the state tax?
Well, it's probably a little of both. I'm not a tax accountant, so I'm going to go out on a limb here. This is why we don't give advice, by the way. But generally, having been a lawyer for 38 years, there's a couple of things I think I can remember. If you own property in Massachusetts, but you live in California, and you have rental property here and you're collecting rents here, you're going to be taxed here on that rental income in that property. And when you sell it, you're going to be taxed here as capital gains. Your home state may also tax you, and then maybe there'll be some sort of an offset from one state to the other. There's rules about that. So it might be a little bit of both, okay? So important to know. All right, what do you need to do a 1031? All right, it has to be an exchange. I mean, this seems almost like almost like double speak. Of course, it's an exchange. The bottom line is this is more theoretical. Your client is selling something and your client is buying something. We know this, but we want it to be treated as if they exchange things. But they're selling something to one party and buying something from a totally unrelated party. If we follow the rules, it'll be an exchange. Okay. If we follow the rules, basically use a qualified intermediary, buy like kind, follow the recipe, and the IRS will consider it an exchange. You don't want to break the rules and have the IRS consider it a sale and then a purchase, because then you'll be taxed. Like kind property held for investment. Okay. Note, only real estate after December 31st, 2017. The new tax law of December 2017 eliminated all other assets from 1031. I used to do airplanes, artwork. I used to do railroads, railroad cars, the rocks under the railroads, everything. We exchanged everything. Now it's only real estate, but you folks are in the real estate business, so that's great. 45 days to identify, 180 to close. We're going to talk about those deadlines. They're very strict. Equal or greater in value and equity on the replacement purchase. So you've got a sale of a certain amount. You got to go equal or greater in value and equity on the purchase. We'll talk about that. And the same taxpayer rule. And I'll tell you some tips about the same taxpayer rule. So if Bill sells, Bill has to buy. But there's a couple of LLC iterations we can talk about. All right. So as I said, the tax law reform bill took out everything except real estate. And that's really all you need to know. This is only for real estate. However, do know that if you're having hotels, okay, if you're selling hotels or things like that, sometimes the incidental personal property can go in the exchange. That was just clarified recently in some regulations. You have a hotel client and they're selling the furniture as part of the real estate. If the furniture is less than 15% of the value of the real estate, it just gets lumped into the exchange. It's treated as boot. You don't get to defer tax on it, but you don't have to segregate it out. Most hotels that I've worked with, though, the hotel is operated by one entity and the real estate is owned by another. So, so that may or may not be applicable to you, but it's good to know there are new definitions of real estate under regs, and they can be broader than you think. And inherently permanent structures are considered real estate. Now, a couple of phrases we're using throughout. Relinquished property is the property that is being sold to start the exchange. Replacement property is the property being purchased to finish the exchange. We don't say sale because sale applies to both. It gets too confusing. So relinquished is old property, replacement is new. Qualified intermediary, that is us, a non-disqualified party who hasn't represented the client in anything except the exchange. And boot is any value taken out of the exchange. When your client wants to buy for less money and take some money out because they want to buy a boat or buy something else, that's called boot and it's taxable. Okay.
Bill, we have a question here.
Sure.
From Robin. Will you be covering more about the like kind? For instance, can I sell a regular rental property and purchase a short-term rental property?
Yes, we will cover that. I'll get to that faster than there's a slide on like kind, and I'll remember to make that point when I get to it. Purchase contract language, I think you're all familiar with this. It obligates the buyer or the seller to cooperate with this 1031. Always remember you got to sign exchange docs before closing. Don't let your clients tell you they've heard from some lawyer somewhere that they can close and then call the QI the next day. That's too late. I get those calls and I have to say, I'm sorry, you can't do an exchange. And the qualified intermediary holds the funds. The taxpayer can't control the funds. Funds go directly from a closing to an exchange account. If you're working with a solid company, and I believe ours is, it's a segregated account in your client's name and tax ID. In an FDIC insured bank, never invested in securities. Watch out for smaller independent companies that might commingle the monies. We do a segregated account for everybody. Property must be held for investment or used in a taxpayer's business. Okay. Is there a time period? Okay. The held for rules are essentially, here we go. There's no time period stated, but your client should hold property for at least a year or two as investment. But be careful here. It's intent as well. Some of your clients have been told by their accountants or by others, just rent for 2 years, then you can move in the next day.
Bill, Deb Higgins is asking if you could go back a screen, and I'm not sure if it's one or two. So Deb, if you just want to chime in. Deb.
I couldn't hear it. There's something vague in the background.
She's mute. Oh, she says two screens.
Here?
Yes, sorry, I just didn't get a chance to read this before you moved on.
Oh, okay. Okay. And I will be setting this out as well, but that's perfectly fine. You can always slow me down. I tend to go fast because sometimes I'm not sure who's I'm belaboring or not. So, but this is purchase contract language, which we can supply you. Okay. We have a suggested language on our website and I can give it to you at any time. And it simply says that the buyer of your seller's contract will cooperate with a 1031, which is to say they'll allow them to assign their contract to us. Okay. Even though title will go directly from your seller to the buyer. And on the buying contract, the seller will cooperate and allow your client to assign the contract to us, even though the seller will deed the property directly to the buyer. This language is important because most contracts prohibit assignments without absolute consent. However, how important is it? I've not seen many buyers and sellers who don't allow the 1031. In fact, I can't remember one in 21 years of doing this. However, arguably they could make a problem if you have a difficult buyer or seller. So it's good to get this language in the contract, either by addendum if the contract's already been signed or at the beginning. But our exchange documents also have to be signed at closing. And let me tell you briefly what the exchange documents are. We have an instruction package for the closer, which in Massachusetts will be an attorney. In other states, it's an escrow company. We have an exchange agreement, which is required by the tax code, where the client is agreeing to hire us to be an intermediary and agreeing to cooperate with the rules and the deadlines. We have an assignment of the contract for relinquish, and later we'll have an assignment of the contract of purchase, assigning the contract to us. But as I said, title still goes directly. The regulations specifically provide for that. And we will prepare a notice that the buyer, if it's the relinquished, or the seller, if it's replacement, will sign to say they got a copy of that assignment to us. The rules say you must assign the contract to the qualified intermediary and notify all parties in writing that you did it. And if you do those two things, the IRS will pretend that your client deeded their relinquished to us and that the seller deeded the client's replacement to us, and we deeded it to the buyer and so forth. So we want that pretend. So we've got to assign the contract to us. You've got to notify all the parties in writing. You don't have to do it. The instructions are given to the parties running the closing. Unfortunately, in Massachusetts, it's the old-fashioned way. You got a seller's lawyer and the buyer's lawyer actually doing the settlement statement. So you got two lawyers involved. They have to communicate with each other. In other states, if you've got a client doing something in Florida or California, it's a title escrow company and all the instructions are going through one person. So, but in any event, that written assignment has to get to the other party. And again, we hold the funds. Funds go straight from the closing to an account that we set up in your client's name and tax ID number. First American for the benefit of, separate from all other of our clients. And we do thousands of these every year. We have thousands of segregated accounts. So your client's funds are, they're identifiable, they belong to them, they're under their social security number. Okay. Taxpayer cannot control the funds. And that's important because they can't also be in someone's hands who would give them to them. So the money can't go into the lawyer's hands, for example, then to us, or to your hands and then to us. Now, it gets a little murky with earnest money deposit, and I can answer any questions about that. Usually you might hold that, and that's usually okay, and you send the excess to us. The IRS understands that we're not a title escrow state, so that happens. Even lawyers hold earnest money deposits, and technically the client has access to those monies if they demand them. The IRS has accepted that and we haven't seen them disqualify anyone. But by and large, the money has to be held by us outside of the control of the taxpayer. And we will tell the taxpayer they can't have the money if they ask at the wrong time. Okay. All right. And these are just best practices, the kind of bank and QI that you should use. Whether it's us, it should at least have these. All right. So held for. Your client needs to hold property as investment or business use for at least a year or two. Generally, 2 is comfortable. But what's not clearly stated here is there has to be intent. They have to be holding it with the intent to be an investor or a business user. What does that mean? That means that you can't just buy a property, put a tenant in, but it's really a property you plan to live in, retire in forever and ever. So the day after the 2 years, you move into it. If the IRS figures out that that was your intent all along, they're going to take away retroactively your deferral. If you flip it too fast, the IRS may say, you bought that to flip it. You didn't really try to rent it, or you didn't really want to rent it. We think you bought for resale. That doesn't count, okay? So you got to be holding it with good intention. But what happens if there's changed circumstances? I had a client once, with a building, $7 million building, to move their business into it. And they started moving, they were ready to move. 2 weeks, it was 2 weeks. A utility came along and said, we've been watching this closing. We want to buy this property. Here's what you paid plus another couple of million. They said, no. Another offer. By the 4th offer, they said no to 3 offers. By the 4th offer, they accepted it. It was too large to refuse. They sold that building 3 months after they acquired it in a like-kind exchange. They didn't hold it for a year or two, but they didn't also market it. It was a changed circumstance. They couldn't foresee it. They didn't bring it about, and their tax advisor was comfortable. You won't turn to me to bless that. The tax advisor for the client will bless it. But that's an example where circumstances can change and they weren't planned and you had good intent. Dual use properties. Sometimes your clients are living in a property and renting part, 2-decker houses, 3-decker houses. They can do an exchange on 2 of those floors and primary residence exclusion on 1 of those floors. You can do a mixed exchange, okay? Dual use properties. Not held for resale. Your clients who are developers and buying specifically to resell do not qualify for 1031. I'm going to tell you, you're probably finding some out there who are doing it. They shouldn't be. They're not doing it through me. I don't think I want that kind of a transaction, but other QIs will take them. But you have to buy for investment, not for resale. Buying for resale is not investment property, it's inventory, and it doesn't qualify, okay? No stocks, bonds, or partnership interests. Okay? Now, here's the question that was asked before. we're talking about what is like kind. All U.S. real property is like kind to other U.S. real property of any kind. Okay, so that doesn't include necessarily the territories. So, for example, Puerto Rico is U.S. territory, but you couldn't buy replacement property there just because of the way the rules are written. So you can go from apartments to retail, from office to warehouse, any of these things. The question, though, earlier about how, let's see, what if it's partly rented? And maybe we can read that question again, Sarah, if it's in writing.
Yes, okay. Will you be covering more about like kind? Can I sell a regular rental property and purchase a short-term rental property?
Gotcha, a vacation home, not a second home. Okay, this is at the bottom of the list here. So any U.S. real property is like kind to any other, so as long as it's held for investment or business use. Your question goes to whether a partial use property, like a partial rental, a seasonal rental property, is considered investment use. It is, and there are some safe harbors that came out in 2008. It is if you rent it to non-family for fair market value for at least 2 weeks in each of the two 12-month periods. And I have materials on this if you need me to follow up with that. So 2 12-month periods after you buy it. Rental to non-family, fair market rent, 2 weeks in each of those 12-month periods. That's a safe harbor, but there's a second prong to the test, which is harder to meet. Your use, your personal use, meaning your own use, use by any or all of your family members, use by non-family who are not paying fair market rent. Your neighbor who says, gee, it's empty. Can I use it for half the rent or no rent at all? Okay, non-family, not fair market. All of those uses are considered personal if they exceed the greater of 14 days in each 12-month period, or 10% of the days that you did rent to non-family at fair market. Then you now have a second home. It doesn't qualify. And if that happens in the first 12 months of your ownership, you can go back and lose your 1031 deferral. So it's not investment property. So let's think about that. Somebody says to me, I'm going to use it 2 weeks. My son will use it too. My daughter will use it too. No, that's 6 weeks. That's beyond the 14 days. And they didn't rent it long enough to get more days. If you've got a renter in there, fair market, non-family, for 5 months, that's 150 days. 10% is the greater number than 14. So you get 15 days. I had a client recently tell me their plan was to rent to a non-family fair market for 11 months, right? Arguably, that's 330 days. So they would get 33 days of personal use, the last month, essentially. That's kind of how it works. But if you don't rent for 5 months or more, you're talking about 14 days in each of the two 12-month periods after you buy. What happens after that? Well, after those 2 years, you've passed the safe harbor. Your exchange into that property should be safe from challenge, and you could change the use to a second home. The problem is, if you sell it as a second home, you will pay all the gains you just deferred into it. What you might want to do is try to plan. I know we humans, especially Americans, don't plan very well. We're sort of reactive folks, but you try to plan ahead and rent it out for 2 years again, the 2 weeks in each of the 12-month periods. Limit your personal use to the 14 days or less. And if you do that for 2 years before you sell it, you could do a 1031 again and defer those gains again into another property. So with a little planning, you can go in and out of vacation and second home use. And sometimes people convert vacation homes into a primary residence later too. You can do that as long as it wasn't your plan from the get-go. Okay. So hopefully that answers your question on like kind. There's some other things on like kind here. Net lease properties, I'm sure you're all familiar with those. I mean, the land under them are constantly bought and sold for 1031 buyers and sellers. Ground lessee positions. You probably don't see this as not that common, but if I'm a ground lessee under a ground lease that has more than 30 years to run, including the term plus any unexecuted options. So I might have a lease it's got 20 years left on the term, but I have 3 5-year options that I haven't exercised. I'm beyond 30 years. I can sell my ground lease, assign my ground lease position to somebody else and treat that as a sale in 1031 and do a like kind exchange. And I can do the exchange into either another ground lease or into fee simple dirt. So that's a unique situation that we see occasionally. Tenant in common interest, fractional interest. If you own 50% of something, you can do a 1031 and the other one might want to cash out. There's some tricks to that. Especially if you go forward in a tenants in common, you want to talk to a tax lawyer about following a certain set of guidance. Sometimes the IRS looks at a tenancy in common and says, we don't think you're really fractional owners. We think you're a partnership, and that disqualifies you. There is guidance that helps you stay within the real estate. So we would share that with you if you need that and send you to a tax lawyer if you have somebody who wants to know about that. If you get 4 or 5 people together. Delaware statutory trust interest. Now I want to talk about that for a second. This is a unique thing. I don't know if many of you know this, and you may think it may not be good for you. Some people sell their investment property through one of you, and they can't find replacement property. There's an animal called a Delaware statutory trust, okay? It's a creature of Delaware. It's simply a trust. And what it is essentially, it morphed from a large tenant in common. So in the 2000s, the first 10 years of the decade of the 2000s, national real estate companies had trouble finding people to invest in their properties and finding cash flow. So they sold tenant in common interest to up to 35 owners in these massive projects, and they were 1031 buyers, and they were just putting $500,000, $1 million in, and all of a sudden you had these properties with 35 separate owners. It was a nightmare, and some of them didn't make it. The industry went to the IRS and said, look, we want to use this trust out of Delaware, which is essentially a business type trust. And the national sponsor forms the trust, buys a portfolio of properties, puts the financing on it, owns it 100%, and goes off and sells percentage interest to your clients. So your client sells a property for $500,000, $600,000, $700,000, doesn't know where to put that money. They can buy $700,000 worth of a multi-million dollar project, a fractional interest, and they own an interest in the trust. Now, normally, I told you real estate has to be real estate to be like kind. But in this instance, if that Delaware statutory trust is formed in accordance with a certain revenue ruling, then the IRS will treat that percentage interest like real estate. So I might go in and buy a 1.35% interest in 6 medical office buildings in a trust. And the IRS will consider that I'm a 1.35% owner of all of that real estate. So that, and you can buy those, you have to be an accredited investor, okay? Somebody who has over $1 million in assets, and there's some other rules on accreditation. You deal with a registered investment advisor. These are like securities. But if you have that type of client and they can't find replacement, that's a good answer. Now, what might you say? How does that help you? Brokerage, okay? Well, sometimes clients don't want to sell, don't want to list their property with you because they're afraid they can't find replacement property in the 1031. So it ends up not making a sale. So this might be some tool you can use to say, well, if you're really worried about this, why don't you go talk to a registered investment advisor? Let me sell your property for you. Okay, let me list it and get that sale, and you can try to find one of these DSTs through your registered investment advisor to buy, and maybe it'll facilitate a sale for you. Now, I know things are selling like crazy right now, and it's not an issue, but things go faster and slower in real estate, and this is a tool you might like to know about. They have to talk to legal counsel and professionals. We can't really advise them. There's a couple of tricks to this. The advantages are they can buy, a small tax owner can own a large asset. They can diversify. Sometimes people might have $600,000 to invest. They'll put 200 in apartments, 200 in medical office, and 200 in something else, retail maybe. They don't manage their property, but let's be real. The management company, which is the sponsor, will take a large management fee, and they should look at that very carefully, okay? The disadvantages, they don't control their real estate. All right. Another disadvantage is there's no real formal secondary market. So once you buy that percentage interest, you may not be able to find somebody who can buy it from you or facilitate a sale. You're in it. Now, what are you in for with these DSTs? It's a long haul. One of the rules in order to treat this interest as real estate is that the sponsor cannot refinance this property ever. So they put on 7 to 10 year commercial financing. And when 7 to 10 years that loan is due, the property has to be sold, regardless of what the market conditions are. Also, some of these sponsors like to sell the property early, like in 3 years, and they just send your client a notice saying, hey, in 60 days, we're having a closing. Go see your QI, go find another DST, find something to invest in so you don't pay your gains tax, and hurry up, because otherwise we're going to cut a check to you. So you lose some control. There's pros and cons to this, but know that they exist, okay? Now, what are the financial requirements? This is important for you too, because when you're finding property for your clients, in order to defer all their gains, they've got to buy something of equal or greater value to what they sold. Okay, so what is that? If they sell something for $700,000 and they owe a mortgage of 250, okay, so they've got 550 in equity. Let's call 500 after expenses. So let's talk about that. Well, the closing expenses are not taxable, so they come off of that 700 cost. Now you're at 650. The $250,000 loan brings your cash down to 400. All right. It's not just enough to invest the 400. A lot of people ask you that. They need to invest the 650. In other words, the amount they paid off on the mortgage needs to be reinvested either as another mortgage on the replacement property, or if they have extra cash. If they have 650 in cash, great. They can put all cash into the new property. You don't have to have a mortgage just because you had one. This is a misunderstanding on the internet. A lot of people call me and say the internet says if I had a mortgage, I must have a mortgage. You do not have to have a mortgage, but you do have to have equal or greater value to pay no tax. Okay, what if I don't want to reinvest equal or greater value? What if I sold 650 after my closing costs? I really only want to buy for 600 and I want to just not reinvest that other 50. Fine. Just know that the 50 is taxed. It's not your basis. It's not your money in. All the dollars not reinvested are taxed to the client from the top. Okay. So that's very important for them to know. They always misunderstand that. Your clients are going to think they just have to reinvest their gain or their equity. That's not true. They will pay tax, but they can put new cash in and they can borrow more money for excess value. You can always buy bigger. Okay. And this slide just sort of shows the example that I don't like to talk a lot about numbers, but you can see that if your fair market value is 10 million and you buy for 9 million, it's $1 million less. Your debt was 6 million, so you went up on your debt. So you didn't use all your cash. You had 4 million in equity, but because you went down in value and up in debt, you now have this $2 million left over in the exchange account to be taxed. And it's called boot. You're going to pay tax on it, okay? Cash is cash boot, and the debt you didn't replace is mortgage boot. But the bottom line is $2 million in taxable money there. All right, exchange expenses versus non-exchange expenses. So what I said earlier was closing costs. Typical closing costs come out of what you have to reinvest, okay? In other words, the broker's commissions, your commissions, the closing fees, they're all tax-free. They can come out of the sale proceeds, and they don't pay a tax on them. It says here that loan fees might not be considered exchange expenses, but tax advisors differ on that. And very often we see the loan fees on the closing statements for certainly on the replacement side, and we will fund them. We won't ask any questions. It's up to the taxpayer and their CPA to decide whether those are boot or are acceptable. So we don't worry about those, but we do talk a lot about security deposits, prorated rents. That's where your client is holding that cash. And very often in a commercial transaction or a rental property transaction, the lawyers will say, and not for good reason, just give the buyer a credit and keep that money, and the buyer can pay you less. That's fine, except in a 1031. If you're selling a $600,000 property and you've got $25,000 in security deposits and partial month's rent to give to the buyer, and you just tell the buyer, just pay me $575, and your client keeps the money, your client took money out of the closing and is going to be taxed on that $25,000. And I always say, why be taxed on what you could have delivered? Deliver a bank check to the closing. Don't have it be a credit on the settlement statement to the buyer. This is true if they're buying a property too. You have a client buying a 15 family apartment unit, and the seller's got 15 security deposits and a half month's rent for 15 of them. Don't have the seller give you a credit on your settlement statement, make them bring the check to closing. The reason being, if the credit means you won't use all your money from the exchange account, it'll leave it in there and we'll have to disperse it to you. It'll be taxable boot. Again, why be taxed on money they could have delivered to you? So we don't like to see these as credits on the settlement statement on either side. Now, sometimes it's okay because sometimes there's more money in the deal. But when I'm giving general information, I like to give a general rule that people can remember. Just don't put it on there, exchange them outside of closing, and you can't get hurt. Okay, so that's a good idea there. Time frames. All right, let's talk about our deadlines. This is very, very important because people get this all across the boards. They get this wrong from whatever's out there on the internet. Essentially, you have, this is what it looks like on a chart, but you have 45 days to identify and 180 days to close, and they both start the day after the closing. So if I closed on my sale today, tomorrow is day number one. What it means is by the time you get to 45 days, you have only 135 days remaining to make the closing happen. So 45 to identify what you want to buy, and the balance of 180 to close it. Okay, no extensions, even if it falls on a Saturday, Sunday, or legal holiday. You've got to give us that identification form by fax or email to us, the QI, and we'll see it the next day and tell you that we got it. Okay. Now, the identification is, what does your client want to buy? This is where they're working with you. This is where you're helping them find properties that they think they can close on within the 180 days. Okay, so you've got to help them find these properties. Now they can buy one within 45 days. So if you've done some great planning and you started maybe before the relinquished sale, and you set up a closing to close 2 weeks after the relinquished property sells, great. They may be done. No reason to do a written ID. Buying within 45 days constitutes identifying. But most cases, they go to the 45th day and they've got to give us a list. And we give them a form for it right after they close relinquished, and we tell them what to do and they send it back to us, signed in writing and signed. Now you can identify up to 3 properties of any value. So this is for people who sold for a certain value, let's say $1 million, and they're looking for $1 million replacement or a higher value replacement. They might list 3 and they want to pick one. All right. If you only put 3 properties on your ID list, you can put any value you want. They could be 3 $10 million properties. The IRS doesn't care about the value of the properties if you limit your list to 3. But if you want to list more than 3 because you just want a lot to choose from, once you list 4 or more, the total value of the properties on the ID list can't be more than 2 times the value of what you sold. So now I sold for $1 million. I list 4 properties. If they're each $1 million, I have a bad exchange. I failed the exchange because my ID failed. It failed the rule, the 200% rule. And because 4 $1 million properties is more than 2 times $1 million. And if you fail that rule, the only cure is to buy 95% of the entire list. Go ahead. You have a question?
Yeah,
No.
we have another question. Deb is asking, because of multiple offers, realistically, we need to have to buy it before we could identify it.
Because of multiple offers, you might need, so the real estate market makes you need to buy it before you identify it. Is that what you're saying? You cannot buy replacement property before you sell relinquished unless we do a reverse that I'm going to talk about a little bit later. But you can buy it within the 45 days. Is that?
No, I was just saying, realistically, if we only listed 3 properties, because of multiple offer situations right now, we don't know if we can even get those properties.
That's correct. Yeah, that's correct.
So that would be the challenge.
I'm hearing a lot about that. And unfortunately, because what I'm about to say is that after day 45, there is no amending the identification and there is no quitting early to get your money early. Once you identify and get past day 45, those are the only properties you can buy. So I try to recommend to people, try to win the bid, try to get the property you want under contract before day 45. It is not a tax requirement. It's only a tax requirement that you list the properties, but because of what you've described, it's generally good to get one under contract if you can. If they can't get one under contract and they're in an exchange and they don't want to lose their tax deferral, here's where those DSTs might be interested. They might be interested in those DSTs because those are groups of funds that are opening and closing all the time. So you get somebody at the 43rd day or 44th day, hopefully they talked to a registered investment advisor before that, but you get them on those last few days and they know they're just not going to win any of the bids. maybe they do a DST and you've saved the exchange. You haven't saved a sale, for you, unfortunately, but you've saved your client who hopefully helped you sell. But get it under contract. And I don't mean offer, I mean under final contract. Okay. Does that answer your question, or is there more to it?
Yes, it just makes it, the market just makes this all more challenging.
The current market makes it very challenging. People do get through it. We do thousands of these each year. So people are getting through it. And hopefully you'll chuckle at this next thing. And I say the dumbest thing. And when your client tells you I've said it, just realize I know that I'm saying the dumbest thing. I also tell clients in a different market, try to list what you really want and try to get that under contract. But the whole idea here is to have two other options. If somewhere after day 45, the thing you really wanted either blows up or title fails, and you want to move to option 2 or 3, and you want to hope that option 2 or 3 are no longer, not been bought by anyone else. So not in the current market, but in former markets that moved slower, I would say, see if your broker can find something that you like that's palatable, but probably won't fly off the shelf. I don't say that too much right now because that's really a kind of a foolish statement, but that's kind of the theory. You're putting two backups that you hope are there. And honestly, in the years past, I've had clients go to their backups and they were still there. I realize today that's not probably likely. But this has been around for a long time, and I hope it'll be around for a lot longer, and markets will come and go. All right. So the 95% rule, automatic ID within the first 45. Okay. No changes to withdrawal or of identification list after 45. So I told you, when you call me on day 60 and say, all my properties got sold to someone else, I can't buy them or taken off the market, can I amend? I said no earlier. Can I get my money now on day 60? No. Once you get past the ID deadline, I have to hold your money until day 180. Really, I can release it on day 181 unless you use it to buy something from the list. So no changes. That's very strict. Now, tenant in common, I told you can buy fractional interests. How do you identify those? Those you identify by the fraction that you're buying. So if you're going to buy ABC 2 Main Street and your client's going to buy 75% interest in it, fine. On the ID, say a 75% interest. Here's the caveat. If you get some really high-end business kinds of clients, often they're still working out their deal with each other and they don't know the percentage, and that gets to be a problem. The bottom line is you can specify how much you're going to buy by dollar value or by percent. You can go down in what you buy by up to 25%. That's not a regulation, but there's an example in the regs that say, if I said I'm buying 100% of 2 Main Street and I want to bring in a tenant in common, I could buy as little as 75% of Main Street and still be deemed to have bought what I identified. And this is the critical rule. You have to buy substantially what you identified. And so what percentage is substantial? Well, an example in the reg says 75%. So you can go down a bit. What if I listed 75%, but after I talk to my co-tenants and we make our deal, I'm really going to buy 80%? There's no regulation or rule that says you can go up. So that's more tricky. You could use your own money to go up, but I would raise a question about releasing exchange funds to buy 80% when you've identified 75%. What do I do about that? I'm not the police. I do want to do things above board, but I tell you to go to your tax advisor, and your tax advisor would have to be comfortable telling you that it's okay. And not many of them will be comfortable. It's not clear. So going up from what you identified is not easy, but going down at least within 25% is doable. And DSTs in the 200% rule. Here, if your client's going to do a Delaware statutory trust on their ID, those DSTs normally have 4 or 5 properties, 3 to 5 properties in them. That kicks you into the 200% rule. So you got to be careful on how you do the ID. And we would have a conversation with your clients and their advisors and kind of explain how to deal with that. Most people who put a DST are doing it, either they've planned way ahead and they're buying it within the 45 days, or they're doing it as a fail safe and they're buying it right at the end. And so they're only IDing it for a day or two because they're going to buy it within a few days. So they can follow the rule easily. But you have to be careful because DSTs often have, if you put 3 DSTs on your ID and they each have 3 properties, you've identified 9 properties and you're in the 200% rule. We can help you with that. Don't get too caught up in the details of that. We don't endorse any investment product, by the way. We're just telling you what's out there. The other deadline that's important for people to know is you get 180 days or the due date of your exchange ends the earlier of 180 days or the filing date for your tax return. This is important for folks selling at the end of middle of October to the end of December. They file their taxes in April. For partnerships, they're filing their tax in March. Okay, the difference in those time periods is not 180 days. So if you get to your tax filing date and you haven't found or closed on your replacement property yet, if you don't file a request for an extension, which is automatically approved, if you don't file that request, your exchange ended on the tax filing date. And if you didn't buy a replacement property, you're out of luck. So you got to extend those dates. The extensions usually run from April to October automatically. The 180 is often sooner than that. Clearly it's sooner than that, because even if you close December 31st, your 180 would be end of June. So your 180 becomes the longest period and you get your full exchange period. So always have to remember that. We try to remind folks of that. So let's see here. Timeline with disaster relief. I'm not going to go too much into this, but know that when there's presidentially declared disaster relief, very often it affects these deadlines if you're an affected person. And being an affected person is a very detailed description. Your client has to go over it with their tax advisor, whoever prepares their taxes, and decide. I mean, it's real easy if you live in a place where there's been the disaster. So if your client lives in Florida and there's a hurricane in Florida that affects your client's county, but they're selling property here in Massachusetts, it's very possible either one or both of the 45 or 180 days gets extended by up to 120 days, right? This is great. I had a client once, lived in Florida, was actually doing their transactions in Florida, was 2 days before their 45 date, named 3 properties, hated them all, didn't want to do it, couldn't find anything yet. I mean, I hate to say this, some people suffered, I'm sure, but lo and behold, a hurricane came through and got declared a disaster relief, and he got 120 extra days. He scrapped 3 he was looking at, went out and not only found one to identify, but bought it within the new identification period, which is 120 days later. And he closed. So disaster relief can be helpful if you're about to miss a deadline, but it doesn't happen a lot up here in Massachusetts. We don't see this very often. It used to be a bit quirky. The disaster had to occur. You had to have closed your relinquished property before the disaster occurred and things like that. In recent declarations, the IRS has gotten more, I guess, more flexible, or they've read the rule again. It's interesting. The rule didn't change, but they reread it. And now there's kind of a couple of ways it's treated. If you're an affected taxpayer, which means you live or work in the area, there might be other ways to be affected, then it doesn't matter if you started your exchange before or after the disaster. This is a wonderful thing. So you might live in Florida and the hurricane came through and you sell your relinquished property a month after the disaster. You still get the benefit of the extensions. Okay, the extensions might not be 120 days. The extension is to the date certain in the ruling, but you're still going to get some extensions. Whereas if you don't live in the area, but you're affected, you're a person whose transaction might be happening there, or whose lawyer might be there, some other ways that you might get the benefit, then you're in the old rules where you had to have started your exchange before the disaster occurred. So a couple of different things have made this more flexible, okay? And that's just section 6 and 17 just tell you the technicalities of which one of those you are. So don't discount disaster relief if your client is having trouble meeting deadlines. It's always worth taking a look. COVID, I still get the question, COVID. COVID has not gone away. It's getting a lot better in many ways. It's getting a lot worse in many ways. There was one COVID extension. It ended on July 15th, 2020. All you need to know for this slide is that's all anyone got. There's no more, and there's no more on the horizon, okay? So that's not any relief you can look to. Same taxpayer requirement. This is really important. You always read online that the title holder who sells relinquished needs to be the title holder who buys replacement. 99.9% of the time, that is correct, but it's not correct because they're the title holder. It's correct because they're the tax owner. What the rule really is, the tax owner who sells relinquished has to be the tax owner who buys replacement. So when you work with me, and I say this right up front in my initial discussion with the taxpayer, there are a couple of animals where it might not be the same title holder. So if Bill Lopriore sells relinquished property, then Bill Lopriore needs to be the buyer of replacement, or I could form an LLC. And as long as I'm the sole member of the LLC can hold title, but I'm still the tax owner. So I have Bill Lopriore taxpayer sold and Bill Lopriore tax owner, sole member of LLC bought, but the LLC is in a different title. Okay. This is true if I held it in LLC when I sold it. I could sell property that I hold in a single member LLC, ABC LLC. I could buy property in DEF LLC as long as I'm the sole member. So I could change the titles. My lawyer would be happy. I could limit my liabilities between those two properties with different LLCs and still be the same tax owner on both sides. Don't want to overlook this. And revocable grantor living trusts are also disregarded. So those work as well. You hold your property in a grantor trust and you buy the new property. Usually you buy it in the grantor trust anyway because it's an estate planning tool. But for whatever reason, you do have other options there. So don't assume title has always got to be the same, especially when you're dealing with single member LLCs. Don't let a qualified intermediary tell you just because it was in a single member LLC on the relinquished side that it has to be that very same LLC on the replacement side. And any tax owner can form a single member LLC. So if you had a seller who's selling property out of a corporation on the sales side, the corporation has to be the tax owner, but the corporation could still be the sole member of an LLC to divide out those liabilities. So very, very good to know on who the same taxpayer is. Okay. If a taxpayer dies during the exchange, the estate or trustee may complete the exchange. That gets a bit messy. I've only seen it once. Interestingly, the tax advisor for the client I saw it on didn't necessarily have the estate complete the exchange. It had the heir, the spouse, complete the exchange. I don't get involved in these interpretations. I just share the information and the tax advisor decides with your client what to do. Okay. So that wasn't so messy, but I'm not sure it was entirely correct either. Consolidated groups, I won't go into that. That's for corporations, unless somebody has a question. So this is what same taxpayer looks like in a couple of iterations. And you'll get this slide. You can take a look at this later and see the different things you can do. Okay. Partnership is a separate taxpayer from its partners. So you get a partnership. You get 3 partners in a partnership. The partnership is called ABC LLC. Well, ABC LLC is the tax seller. That's the party that has to sell and the party that has to buy, be the tax owner on the buy side. But what do you do when you get 3 partners who hate each other, which is almost always the case when they get to me at least, and 2 of them want to cash out and 1 of them wants to reinvest and go further with an exchange? That becomes difficult. Okay, you cannot trade a partnership interest. All right, so the partnership has to do it all or nothing. The partnership sells, partnership buys, but we do have some strategies in the tax world. Okay, you can't exchange the partnership interest, but we do this thing called a drop and swap. And I would get your client, I would recommend a tax attorney who knows this, because not all tax attorneys understand 1031. There's a structure where you break that partnership out into tenancy and common interests, preferably the year before they sell, but the taxpayers never tell you in time. So I've seen it done even in the same tax year. And now your client has their fractional interest and the other partners either have their fractionals, or maybe the partnership stays intact and only your client has a tenant in common with the partnership. But the bottom line is your client's in a position now to sell real estate and do an exchange. Does the IRS want to challenge these? Sure. Have they been challenging all of them? Can they survive a challenge? I have tax lawyers who have defended them and won. So if that's the situation that your client has, there are ways to deal with that and please everyone. All right. Some get their cash, some reinvest. Partner can acquire all remaining partnership interests. This is really a neat trick. If your client has sold relinquished property and is in a partnership with others, but wants to buy them all out. So your client is a 1/3 interest in 2 other partners, and if he or she buys the 66% interest of the other partners, he's bought the partnership interest, but it immediately is treated as a real estate purchase. That 66% of that property is replacement property for your client's exchange. Okay, that works. That was not even for 1031. That's a general tax rule. Now, the partners who are selling their interests cannot do a 1031. They're selling a partnership interest. Your client, if they bought 100% of the remaining interest, bought real estate under the tax rules, but the sellers of those interests sold partnerships. And the really neat trick, if your clients have a partnership and they don't like each other, I have seen this, is no more deemed termination interest. Your client, say 50% partner with somebody else, wants to go forward without that partner. That partner wants to get cash. If your client has the money, your client can buy that partner out and bring in a 1%, a spouse or a child, because you need two partners to continue a partnership. What we want here is we don't want the partnership to end. Okay, we want the partnership because if it ends, then it hasn't held, if it ends, then whoever's selling the property hasn't held it for 2-year holding period. So we want to preserve the partnership as a seller of relinquished property because it's the one that held it for 2 years. But we don't want that partner anymore. Prior to 2017, if more than 50% changed hands, the partnership was deemed terminated and you lost your holding period. They changed those rules. Your client can buy out even a 51% partner, bring in a 1% partner at the same time. The partnership stands. Your client now owns 99%. Go forward, sell the real estate, do an exchange. You haven't lost anything. That came out of the new tax law in 2017, and it's been used a lot. Related party exchanges. Who's a related party? Mothers, fathers, sisters, brothers, children, companies you own an interest in. What's the problem? The IRS doesn't like it. When you exchange with a related party, they think you're shifting the basis and somehow cheating on the taxes and taking an advantage. But they've clarified it. Two parties can swap, and this believe it or not, this happens. Parties, I have what you want, you have what I want. We do a direct swap. If we're related, that's okay as long as each of us holds our properties for 2 years. So that works. And I see a lot of family partnerships or family groups that hold as tenants in common. I had an auto dealership recently. They were all in business together. They all owned the auto dealership, and they just swapped them all out so that each of them had some of the dealerships, and that worked. They had a good exchange and they held. But sometimes you want to sell to a related party. That seems to be fairly well clear with the IRS. There may still be a 2-year holding period, but selling to a related party, if I want to sell to my brother, they don't seem to be bothered by that. I can start an exchange. Buying from a related party is the problem. If I sold to you and I want to buy from my brother, the IRS is not going to like that unless my brother is also starting an exchange with that sale. They're pretty adamant about it. They have won in tax court on it. Now, IRS doesn't always win in tax court. Tax court is favorable to the taxpayer, typically. They've won on this. So your client cannot be buying from the related party unless that party is also doing an exchange. Very often, that party can't do an exchange. What I see a lot of is parents who sold tenant property and they want to buy their kids home to help their kids out to move on to the next house. And they say to me, but I'm going to rent it. I'm buying it to rent. That doesn't matter. Since they live in it, they can't do an exchange. The IRS will not qualify it because they think you're shifting basis somehow. They think it's an abuse of the system. So that doesn't work. Interestingly enough, cousins and aunts and uncles are not on the list of related parties. Spouses are related. Ex-spouses are not surprisingly, okay? So I've seen some of that, okay? So, and spouses are not related to their in-laws. So my wife could buy from my mother, all right? And as long as I'm not on the deed, I'm not part of that. My mother could do an exchange and sell to my mother could buy from my wife and complete an exchange, or my wife could buy from my mother and complete an exchange. So related parties is something to think about. Reverse exchanges. This is to control timing as well as value. So your client has something to sell, but they found the perfect property to buy. And as Deborah had said earlier, because your picture is still up on my screen there, Deborah, I hope you don't mind. As Deborah said earlier, this market, sometimes you have to jump on a property. So if your client has the money to do this, or the banking of relationship to do this, your client could bring us in to buy the replacement property for them and hold it for up to 180 days while they then proceed to sell their property. And what's nice about this is you don't have to deal with the uncertainty of the 45 days after the selling of the property because you've already bought the property and placed it with a friendly party, us. All right, but we can only hold it for up to 180 days. You have to fund us. We don't have any money to loan you. So you either make us the borrower on your bank loan, and the banks by and large have understood this now. This came into being in 2000, September 15th of 2000. Most banks seem to know that we're not a credit party. We're just holding it for tax reasons, and they get their guarantees and their credit from your client. But you have us buy it, we hold it, we lease it back to the taxpayer, who can then rent it out to others and operate the property. Then they go off and sell their relinquished. Within about a week after, they buy the replacement from us, and the money from the sale of relinquished goes to pay them back on their equity loan. What is the equity loan? Maybe your buyer needs to borrow money to buy this property, maybe 70% from a bank and 30% is their equity. Well, we become the borrower from the bank, and we borrow the 30% from them under a promissory note. So when they sell the relinquished property, the money comes to the exchange. We use that money to pay off our equity loan to them. They get their cash after they've taken their property. And, we do it with an LLC so that the LLC is the borrower and the lender they're still the borrower on the loan. It's a way to control timing, okay? But there are some Revenue Procedure 2037 has safe harbors that we have to follow. The Ninth Circuit Bartell case, just forget about it. It's somebody who wanted to do it for not 180 days, but 2 or 3 years. And in most cases, the IRS has said they would challenge it everywhere outside the Ninth Circuit. The Ninth Circuit is California and the West Coast. It's just a very risky, expensive transaction. If you have somebody who wants to do something longer than 180 days, we can get you to a tax advisor, but it's going to be very expensive and probably not worth it. So this allows you to close on the purchase without worrying about the forward 45 days. There is a 45-day period in reverse, though. Once you have us take title to your replacement property and hold it for you, 45 days after we take title, you have to identify properties you might sell. Now you're saying to myself, well, Bill, we know what we want to sell. It's on the market. Well, you want to probably identify a couple of things if you own many properties, because if that sale just never happens, you might have to, you can only use in that reverse property you have identified that you would sell. So if you have a couple others that might go on the market, you list those on your ID. Same rules, 3 properties of any value, more than 3, 200% of the parked property. And therefore, if the thing you're really focused on doesn't sell, but the other one does, you can still take what we're holding in an exchange. You haven't lost your right. Disadvantages you have to acquire without having your exchange funds. So you need to have enough money to fund the purchase without selling the property. Financing issues, banks can get difficult. Additional costs. There is a large fee. Fees normally run, for a regular forward exchange, like $1,500 if the property is under $5 million, and it includes your relinquished and your replacement. Some QIs do it for less. They might be independent QIs. We're a public company holding your funds a certain way. But if you want us to hold title, it typically gets up into the $10,000 range, because we've got a whole separate transaction there, and we're going to have some risk. If somebody slips and falls there, they're going to sue First American. We're the owner of the LLC that owns that title. And so there's a lot more money there. Even QIs that might be less, they're still going to be in the thousands of dollars to hold property. So it has to be worth it. I don't recommend it to everyone. Okay. You can also do building improvements. Let's say your client buys a property, they've sold something for $600,000. They buy the perfect property for $550,000, and they say, Bill, I need a new roof and new doors, new windows, and I can do that in about 2 months. So I want to put that money in during the exchange, so I get a full $600,000 value. How do I construct during the exchange? Well, and I want to use my exchange money too. Well, you can. So after you sell relinquished and the $600,000, if it's all equity, is sitting in our exchange account, then you have us buy the replacement within a month or so. We own it just like we did in the other reverse. You make the improvements to it. We distribute some of the money to do the improvements, to buy it. We distribute the money to buy it as well as to do the improvements. And before day 180 from the time you sold, you have to take that property from us, usually by an LLC that we own. And then it has more value. It's worth 600, and you've had a completely efficient exchange. There's similar drawbacks as reverse, putting the money out, etc. That is it, and we've left a little bit of time here for questions, if anybody has, or if anybody wants me to revisit something because I went so fast you couldn't hear it. Let me get back to the screen here. Let me stop sharing. Well, I can stop sharing actually. And are you seeing me? Can you hear me, Sarah?
Yeah.
Okay, great. Does anybody have any questions?
If you guys want to
life and
unmute
times-
yourself. Come on, Steve, you've got to have a question.
Did I
I
render
have a
you
question.
speechless? Bored or speechless? Bored is okay, because this is tough stuff. Go ahead. Who has a
I
question?
have a
question. So could you put a property, the replacement property under agreement first, and then just have a long closing time so that you could really sell your property that you own first, and then finalize the purchase?
Yes, that's a very good strategy if you can make it happen. You always want to try to sell first and buy later. And yes, you're right. The difficulty is trying to find something to buy. So when people come to me and say, after the fact, they've already found the perfect replacement, so they're talking now about an expensive reverse, I say, look, if you're close in time, can you just move that relinquished closing date to a point where, you know, or move that replacement closing date to a point where you can close first. So that's a little bit about the reverse of what you said. You do want a long relinquish date, but then you want to be able to pull the trigger. Okay, so be careful here, because you can negotiate a long relinquish date. So I'm selling my property and I say, I want to close 3 months from now. But what if you find the perfect property in the market tomorrow? You want to pull the trigger and close now. So be careful with that. What I thought you were saying, and I'm going to go to it, is you want that long closing date on the replacement side.
Right.
You found the perfect property, and you want to stretch that one out, or
Yeah.
at least have the ability to pay a little more money and move that one. Okay. Is that what you were asking? Probably what you were really thinking.
Yeah, because that will be a good solution to avoid the reverse exchange.
Absolutely. What can you give the seller to get them to wait? Because it's a hot market, and they say, gee,
More
what if I
money.
lose you? More money.
More money.
And more money. Rather than pay $10,000 on a reverse, give them a couple $1,000s or something like that, you know, and just extend it, you know. So good question. Happens all the time. Anyone else? Any situations you've seen? Go ahead.
Bill, I have a question for you. You had talked about the boot money. So I was always of the understanding that if there was any boot left, that the entire tax had been paid. So that's not true. It's only on whatever.
That's a fantastic question, because a lot of people believe that, and there's things out on the web that say if you don't reinvest equal or greater value in equity, you have a bad exchange. But that's not true. You just have boot. Okay, so I see it all the time. People want to buy down in value. They may not want to be as invested. So you are absolutely right. Now, remember, there's two types of boot. So you buying down in value, it might be that you're not reinvesting all your cash. That's cash boot. But if you buy down in value, it might be that you're not replacing a mortgage. So you've used all your cash, but you just didn't replace the part that was payoff of mortgage. That's mortgage boot. But anything down in value is okay, but you'll pay tax. Now be careful. This is where you need to know your tax basis very carefully from your accountant. Your tax basis, remember, is your money in minus depreciation plus capital improvements, whatever they're showing on the tax books is your money in. So if I've sold for 600 and my money in is 550, but I want to buy down and buy only something for 500, I didn't reinvest greater than my basis. I may have a good exchange, but I didn't exchange anything because I didn't replace greater than my basis. I didn't replace any of the gain. So you can go down. Watch out how much. If you go too low, you shouldn't have hired me. Okay.
So if you buy as greater than your basis, you're good, even if you have cash money left over.
If you buy greater than your basis, you're good as to the amount greater. You've deferred gain on that, even if you have cash left over. So we'll look at that example. If you sold for 600, your basis was 500, and you bought for 550, you've deferred tax on 50,000, and you're going to pay tax on the remaining 50,000, and that's okay. I once had a client sell a $10 million, but this is wonderful to be this wealthy, isn't it? A $10 million building, and only wanted to do the exchange on 1 million. And I questioned it, and I said, you're only deferring tax on $1 million. Yep. She knows it. Yep, she knows it. My guess is she was going to buy something for $1 million anyway, and said, well, why not? Why not defer tax on $1 million? I really don't care if I pay my taxes. I would love to be in that position. I wouldn't be sitting on this video with you lovely folks.
No, in that example, do you hold all of the money, or did you just hold that $1 million?
No, and that's another good question. So if you're planning to take boot out at closing, you're allowed to take money from the relinquished closing. So I told you earlier that the money from the closing has to go to the exchange account. And we're going to refine that now and say only the money you want in the exchange. The points at which you can take money from an exchange are at closing of the relinquished, can't change your mind. I had a client call me 2 days later with $1 million and say, I want that in the exchange. I took it out. I'm sorry, sir. Going to pay tax on it. But you can take it at closing. And so she took her 9 million at closing and just let $1 million come to us. The next point you can get your money is during the 45 days to buy replacement property, or on day 46 if you don't identify. Then you can take money if you don't identify. Whatever we're holding, the exchange is over. Once you identify, then to buy anything from 45 to day 180, any money left on day 181 you can get. So yeah, beginning, middle, and end, and you can send us only what you want to send us. I've had cashless exchanges. I've had exchanges where all the money went to pay debt. I don't like them because they're hard for my staff, because we kind of track money to know that an exchange is open. They have to now make notes in our database to say there's no money here, but there's an exchange still going on. All right. I've had clients who, I had a client sell for, I forget, it was $1 million plus, maybe $1.6 million. $1 million of it was debt, 600 was cash. They replaced the 600,000 with property. And I noticed they weren't, the 45 days was coming in and I wasn't hearing from them. And I said, hey, you're going to pay tax on that other $1 million. It was debt. You know, do you want to identify some property? She had property she was ready to buy for $1 million and did not know that she would have paid tax. And so bing, bang, boom, we did that as another property in the exchange, and she deferred all her tax on what would have been $1 million of mortgage boot. So we can't always spot that. We try to tell you up front about that, and we try to spot it, but that's why we give these education seminars.
Does it matter how many properties you buy as replacement?
You can buy, this is a trick really answer. You can buy as many properties as you want. However, if you don't buy them all within the first 45 days and you get to the point where you have to do a written ID, now what you're limited by the ID rules. I mean, you can buy as many as you want, but the ID rule might limit what you can place. Okay. And that's important because they're asking you to help them find the properties, correct?
Yeah.
You know, I'm curious about any of you, what did you think about the DST as a way to help you to convince someone to sell? You probably don't need that right now because everybody's selling pretty easily. But in my 21 years doing this, I can tell you there were times when sellers were hesitant to sell because they couldn't find replacement. Or even now, some are saying, I know I can sell, but because of the bidding wars, I can't find anything. You think your clients would be interested in that securitized DST type property?
I'm thinking it'd be a valuable proposition for somebody that doesn't want to actively manage properties anymore, but not pay taxes on the sale of their properties.
Right.
Then the DST would be a nice vehicle to pass on in the estate rather than properties.
Sure. So if they were hesitating to list it with you, maybe it'll help that happen. They'll be more comfortable if they know about those.
Yeah.
Who offers those, and what kind of returns you get on the money you put in?
Well, so I keep short lists of those people and short lists of tax lawyers, and I say short list because I'm not a broker of people, but I do have a list of a couple of people that are actually in the business and that other clients have used. Typically, you're dealing with a registered investment advisor broker type, okay? You have to be able to be a financial advisor. So, and it's more like a salesperson. And that person introduces you to these funds. And then there's a true registered investment advisor that gives you all the disclosures. What are the returns? I want to say, I haven't really looked into that carefully, but is it a 4 or 5? They're not great. They're not the greatest returns. You're in it for a different purpose. Maybe you just don't want to manage your cash and don't want to pay tax and can't find anything to buy. You want to be careful too. The short list that I keep are people who sell for all the companies that are sponsoring them. A lot of your clients might find a sponsor that's selling their own properties. And so they're only going to show you a limited subset, okay? And some of these others will show you larger. But if any of your clients need that, I'd be happy to share the names of the people that I've given names. I haven't heard anything bad about any of them. It's also true of net leased properties. I don't know, do any of your clients buy net leased properties? They tend to be very, very expensive. So they'd be either your larger commercial clients. The CVS is sitting on a plot of dirt, right? The TD Banks, the Bank of Americas. The dirt underneath is bought and sold. And I also have a good friend of mine for 20 years or so of who's a broker in those and sells them all over the country. 1031 people buy and sell those all the time. There's some risk there. If that net lease is, you got CVS on the property, and they're a bond rated tenant and they're going to be there, but will they be there forever? Everybody can fall, right? If you buy one that's too old, will a company like client Staples did this to a client of mine? They came in and said, hey, cut the rent in half or I'm moving up the street to build a new one. So net lease property has its pros and cons, but that's out there too. And I know people who sell those. What else? Any other questions? And hopefully everything was clear. And so I think the key for you is, the bottom line that I will send you is really a great quick way to have to show your clients what the basic rules are without you having to memorize them and get caught up in the tech. Look, you're selling real estate. You're not trying to sell 1031. 1031 is supposed to help you sell the real estate. So I'm going to send the bottom line sheet to you. It's a nice. You saw it was like a checklist, and I'm going to send you the sheet on investeagle.com. And I invite you to go into investeagle.com. Nobody charges anybody for anything. Even clients who aren't working with us can go in and look for properties and check it out. You can look for properties all over the country, which means your listings here in New England can be looked at by other people in other parts of the country. A lot of box tenant properties on there, but there's also some other types of multifamilies and other things. I haven't been on there lately to see what's populating. Do take a good look at that, and you can do volume uploads. You can talk to your team, your Keller Williams folks there. Maybe they're doing it with our California office. I think they're more in tune with the larger brokerage companies, and they may already be posting on our site. And it's free.
Close out, Bill. We can have our clients, if you have someone looking to 1031 exchange, also reach out directly to you with contact information. I'm sure we can send.
Yep, fantastic. And I'll talk to anybody, and anybody who wants to call, I'm always happy to talk to them. And sadly, if they don't qualify, I tell them that I don't think so. And if they do, we tell them what they need, and we make it simple. I have a team that takes it over.
I appreciate it. Take the time and the information. It's been great.
I want to thank you for having me. It's really been a pleasure, and I really appreciate the opportunity to get in front of you, to meet all of you, and to do this.
Thank you so much.
No one else has any other questions? I guess we can call it.
Thank you, Bill.
Thank you. Take care. Have a wonderful day.
You too. Bye-bye.
I have the old lady.